All right, welcome back to TalkTickers, everybody. We're jumping into another earnings deep dive, and oh boy, this one's a big one.
Oh yeah, it's definitely a lot to unpack here.
It is. We're talking NIO today, and their latest report is, well, let's just say it's sparking a lot of conversation online and in the markets.
For sure. You've got the record deliveries, the improving margins, but then that net loss figure is, well, it's making some people nervous.
Exactly. So let's not waste any time and dive right in, figure out if NIO is really on the road to success here, or if there are some potholes ahead.
Sounds good to me.
So first things first, paint us a picture here. What were the headline numbers? What jumped out at you right away?
Well, right off the bat, Q4 deliveries hit a record high, 72,689 vehicles out the door.
Wow, so they crushed their own expectations.
Oh yeah, big time. And December alone saw over 30,000 deliveries, so they ended the year on a huge high note.
Okay, so that's Q4. What about the full year picture?
For the whole of 2024, they delivered 221,970 vehicles, which is a hefty 38.7% increase year over year.
Almost 40% of growth. That's got to have investors excited.
It does paint a rosy picture, but of course, it's not just about deliveries. Profitability is the name of the game, and that's where things get a bit more nuanced.
Right. So let's dig into the financials. Give us the lowdown on margins and the all-important bottom line.
Okay, so on the positive side, their vehicle margin for Q4 was 14.9%, which is a nice improvement. And what's even more interesting is that their ONVO brand, remember that's their newer brand targeting a more mass market segment, well, they actually hit a positive vehicle margin pretty early in their production cycle.
Oh, wow. So the ONVO brand is already contributing positively to the bottom line. That's impressive.
Yeah, it is. It definitely bodes well for their multi-brand strategy. So yeah, ONVO helped to bump up the overall company vehicle margin to 13.1% for the quarter, and their gross margin also ticked upwards to 11.7%.
So margins are moving in the right direction. That's got to count for something.
Yeah.
But what about overall revenue and, did they actually turn a profit?
So total revenue for Q4 came in at 19.7 billion RMB, a respectable 15.2% jump compared to the same period last year.
Not too shabby at all.
No, not bad at all. But, and here's the big BT, they did report a net loss with a quarter of 7.1 billion RMB.
Ooh, okay, so still in the red.
Yeah, and that's definitely something investors are keeping a close eye on. But on a brighter note, they closed out the year with a comfortable cash position of 41.9 billion RMB.
All right, so they've got some breathing room financially, which is good to see. Let's shift gears a bit and zoom in on their brand performance. We know they've got the core NIO brand and the newer ONVO. How are those shaping up?
Yeah, so the NIO brand is still their flagship, and it's doing really well, especially in the premium segment. They delivered over 201,000 vehicles in 2024 and have a commanding 40% market share in China for EVs priced above 300,000 yuan.
So they're the kings of the premium EV hill, at least in China.
For now, yeah.
Yeah.
But the competition is heating up, so they can't afford to get complacent.
Absolutely. What about ONVO? We touched on their margin performance, but how are their sales looking?
They moved a respectable 20,761 vehicles last year, and their L60 model, which is an SUV in that sweet spot between 200,000 and 300,000 yuan, it's actually one of the top 3 best-selling electric SUVs in that price range.
So ONVO is gaining some real traction. That's got to be encouraging.
Oh, absolutely. And they're not stopping there. They've got another brand in the works, Firefly, focused on the high-end small car segment. They're aiming to launch and start delivering those in April.
Wow. So 3 brands all going at the same time.
That's the plan, although it's ambitious. Having 3 brands can be a real juggling act, but they seem pretty determined to cover all their bases.
Makes sense. Cast a wide net and see what sticks.
But launching new brands is one thing. What about new products? What did they tease for the year ahead?
Oh, they've got a whole lot cooking. Let's start with NIO. They just launched their ET9 flagship sedan. This is their top-of-the-line model, aimed at executives and folks who want the absolute best.
Sounds fancy. It is. And it's apparently selling like hotcakes, too. The limited first edition they released sold out almost immediately, so there's clearly a lot of demand for a premium NIO sedan. Deliveries for that start at the end of March.
Okay, so a strong start for the ET9. What else?
They're also refreshing some of their existing models. So the ET5, ET5T, ES6, and EC6 are all getting a facelift, so to speak, with updated designs, better tech, and a brand new smart driving chip. Those are scheduled to launch in Q2.
Sounds like they're keeping their lineup fresh. Anything else on the NIO front?
They were a bit cryptic about it, but they did say they have another major product launch planned for the second half of 2025.
Intriguing. And what about ONVO? Any new models coming down the pike there?
Yep, they're adding to their SUV lineup.
Uh,
In Q2, they're launching the L90, which they're positioning as their flagship large family SUV. Deliveries for that one are slated to begin in Q3.
all right, so another SUV for the masses.
Exactly.
Yeah.
But they're not just playing the volume game. They also mentioned that they've got a third ONVO SUV in development, set to debut in Q4. And this one, they're aiming at a higher margin segment.
Oh, interesting. So going a bit more upmarket with ONVO.
It seems that way, yeah.
Yeah.
But they didn't give too many details, but it sounds like they want to position ONVO as a brand that can appeal to a wider range of budgets and preferences, not just the entry-level buyers.
That's a smart strategy. All right, so we've got a ton of new models hitting the market this year from all three brands, which, sounds exciting, but also a little overwhelming.
Yeah, it's a lot to manage. 9 new models. That's got to put a strain on their resources.
No kidding. And that brings up a crucial question. How are they planning to pay for all of this? And even more importantly, can they do it without bleeding money?
Right. Cost management is absolutely key here. And they did spend a good chunk of the earnings call talking about their efforts to rein in expenses and boost profitability.
So what's their game plan? Lay it on us.
Well, for starters, they're really focusing on squeezing inefficiencies out of their supply chain and R&D processes. They actually credited these ongoing cost-cutting efforts with helping to improve their vehicle margins in Q4.
So making the most of what they've already got.
Exactly. But they're not stopping there. They have launched a company-wide initiative involving every single employee that targets cost reduction across all departments: R&D, supply chain, sales, you name it.
Wow, so a full court press on cost control?
Yep. And they're hoping to start seeing the positive financial impacts of these efforts as early as Q2.
Okay, but cost cutting can only take you so far. What about their revenue and margin targets? What are they aiming for?
Their big, hairy, audacious goal is to achieve break-even by Q4 2025.
Whoa, okay, that's ambitious.
It is, no doubt about it. But they believe it's achievable through a combination of growing sales volumes, boosting vehicle margins, and keeping a tight lid on expenses.
So a three-pronged attack on profitability. Dig a little deeper on those margins. What specifically are they targeting?
They're aiming for a 20% vehicle margin for their NIO brand and a 15% margin for ONVO.
Okay, so significantly higher margins than they're currently achieving.
Exactly. And to hit those targets, they've laid out some pretty specific strategies.
All right, break those down for us. How do they plan to get there?
One big focus is platform-based design, basically maximizing the commonality of parts across their different models. For example, by using a shared seat structure for both NIO and ONVO vehicles, they expect to shave 10% off their bill of materials cost for seats alone.
So economies of scale in action.
Precisely. And it's not just seats, they're standardizing other components as well, especially the smart hardware interfaces. This way they can leverage higher volumes to negotiate better prices with suppliers and simplify their production processes.
Makes sense. Any other tricks up their sleeve?
They're also putting more emphasis on developing key components in-house, like their NX9031 smart driving chip. They believe that building these things themselves, rather than buying them from external suppliers, will lead to significant cost savings.
That's a bold move going vertical like that.
It is, but it shows they're really serious about controlling costs and building up their technological capabilities.
Smart, smart. All right, let's circle back to ONVO. It's clear they see it as a key growth driver, but we've also heard they've faced some challenges. What's the story there?
Yeah, so management admitted that ONVO sales haven't quite lived up to their initial expectations.
Not a great sign.
Well, they blame it mainly on lower brand awareness compared to their competitors. They estimate that ONVO's brand recognition is currently only about 1/3 that of NIO, which makes sense. ONVO is the new kid on the block, so they've got some catching up to do.
So how do they plan to close that gap?
They're hitting the marketing hard, both offline and online. Think billboards and train stations, ads in apartment elevators, and a much bigger push on social media.
So a full-on brand awareness blitz.
Exactly. They're also working on expanding their sales network. They've got over 400 ONVO stores now, which sounds impressive, but many of those are still brand new, so their sales teams are still getting up to speed.
Right, so it's going to take some time to build up that sales muscle.
Definitely. They acknowledge that about 60% of their ONVO sales force has less than 3 months of experience. So there's a lot of training and development happening behind the scenes.
That's a lot of new hires to get up to speed.
Oh yeah, it's a big undertaking.
Yeah.
And that's not the only challenge they're facing. Remember their big bet on battery swapping?
Of course. How's that playing out for ONVO?
They've been expanding the availability of power swap stations for ONVO users. There are over 1,500 of them now, in China. And they're also boosting their battery supply to make sure those stations are well stocked.
Smart move, because if those stations are empty, it defeats the whole purpose.
Exactly. And they've noticed something interesting. ONVO sales tend to be higher in regions where there are more swap stations available.
Makes perfect sense. People are more likely to buy into the battery swapping concept if they know they have convenient access to it.
Right. So the takeaway here is that the Power Swap network is not just some fancy gimmick. It's a real driver of sales, especially for ONVO.
Okay, so despite some early hiccups, they're taking concrete steps to address ONVO's challenges. But what about the competition? The Chinese EV market is notoriously cutthroat.
Oh, it's fierce out there. And management didn't sugarcoat it. They even admitted that ONVO has been hit by some negative PR, which they estimate has hurt their sales by about 30% to 40%.
Ouch, so that's a significant headwind.
No doubt about it. But they also pointed out that the L60, their main ONVO model, has really high customer satisfaction ratings and a strong referral rate.
Ah, so word of mouth is working in their favor.
It seems to be, yeah. And that could be a powerful counter to the negative press they've been getting. So despite the tough competition, they're not throwing in the towel on ONVO. In fact, they're looking for ways to integrate the NIO and ONVO brands even more closely.
Oh, interesting. How so?
Well, they're already sharing a lot of resources, like after-sale services, power swap stations, and even some back-office functions like finance and HR. And now they're experimenting with even closer integration in sales and service management in certain regions.
So trying to create some synergy between the brands.
Exactly. But they're also being careful not to blur the lines too much. They're keeping the sales network separate, for example, although they are running pilot programs that encourage sales teams to sell both NIO and ONVO vehicles.
Makes sense. You don't want to cannibalize your own brands.
Right. It's a delicate balance. But if they can find the right formula, this closer integration could be a real win-win, streamlining their operations and boosting overall sales.
Okay, so they're pulling out all the stops to make ONVO a success. But let's talk hard numbers. What kind of sales volumes are they forecasting?
For Q1 2025, they're projecting deliveries between 41,000 and 43,000 units, which would be a pretty impressive 36% to 43% year-over-year growth.
So continuing that upward trajectory.
That's the hope, yeah. And for the full year, they're sticking to their ambitious target of doubling 2024's sales volume.
Wow, so they're not shying away from aggressive goals. What gives them the confidence to set such a high bar?
Well, obviously the 9 new product launches across their 3 brands play a big role. They're betting that this flood of new models will attract a lot of new buyers.
New products always generate buzz, that's for sure.
Right. But they're also banking on the continued expansion of their power swap network. Remember how we talked about that driving ONVO sales? They believe it'll be crucial for hitting their overall volume targets as well. They're specifically focused on expanding into lower-tier cities and reaching county-level coverage in more provinces. Their goal is to have a presence in 27 provincial-level divisions by the end of the year.
So taking battery swapping to the masses.
Exactly. And I think that's a key takeaway here.
Yeah.
They really believe that their battery swapping technology is a major competitive advantage and a key driver of future growth.
It's certainly a differentiator, that's for sure. But let's talk about another big differentiator in the car industry these days. Technology, and specifically AI. What's NIO doing on that front?
They're actually pretty far ahead of the curve when it comes to in-car AI. Remember NOMI, their AI assistant?
Vaguely. Remind me.
It's that cute little robot-looking thing on their dashboards that can control various car functions with voice commands.
Right. I remember seeing that in their ads. So what's new with OMI?
Well, they've been steadily beefing up its capabilities. It now has its own large language model, NOI AI GPT, which means it can understand and respond to natural language even better than before. And they're even opening up to third-party models so developers can create all sorts of new apps and features for it.
So basically turning NOMI into a platform.
Yeah, exactly. And get this, NOMI even generates revenue for them through merchandise sales.
Seriously, people are buying NOMI swag.
Apparently so. It's become a bit of a brand icon for them.
Huh, that's pretty clever. But beyond NOMI, how else are they using AI?
AI is also playing a big role in their smart driving technologies, specifically their NIO World Model, or NWM for short. This is basically a super sophisticated AI system that helps their cars understand their surroundings and make better driving decisions.
So like a brain for their autonomous driving system.
Yeah, you can think of it that way. And they're constantly improving it. They've got a new, even more advanced version of their driver assistance system based on NWM that's entering early testing in April.
Sounds like they're really pushing the boundaries of what's possible with AI.
They are, but they were also quick to point out that their primary focus is still on being a car company. They see AI as a tool to enhance their products and make their business run more efficiently.
Makes sense. Don't get distracted by shiny objects.
Right. But they're clearly investing heavily in AI and see it as a key differentiator for their brand.
Smart move. It's definitely an area where they can stand out from the crowd.
Absolutely. And they're not just relying on their own internal AI expertise. NIO Capital, their investment arm, has poured money into a bunch of AI startups, so they've got their finger on the pulse of what's happening in that space.
So a well-rounded approach to AI.
Yep. And they're already seeing tangible results. For example, they've rolled out an AI-powered active safety system that's already led to a 40% week-over-week improvement in safety performance.
Wow, that's a big jump. So the AI is actually making their cars safer.
It is, and that's huge. And they've got even more AI-powered features in the pipeline. Their Navigate on Pilot Plus system, which is designed for city driving, is slated for release by the end of April. And they're also going to start integrating their in-house developed NX9031 smart driving chip into future models, beginning with the ET9 and then the 2025 model year 5 and 6 series.
Sounds like they got a pretty impressive AI roadmap ahead of them.
Yeah, they're really going all in on AI, and I think that's going to be a big part of their story going forward.
All right, let's wrap things up with the financials. We talked about their cash position earlier, but what about their operating expenses? Those can make or break a growth company.
Yeah, so they expect their R&D expenses to stay relatively stable at around 3 billion RMB per quarter throughout 2025. But they're putting a big emphasis on making sure those R&D dollars are spent wisely. They even have a fancy internal mechanism called CBU, which basically stands for a system that encourages their R&D teams to be more cost-conscious and accountable for the projects they're working on.
So no more blank checks for the engineers.
Pretty much. But they're not just focusing on R&D, they're also looking to streamline their sales, general, and administrative expenses, or SG&A for short.
And how's that going?
They admitted that SG&A was a bit of a challenge in Q1, mainly because of the usual seasonal slowdown in sales and the ongoing investments they're making in ONVO's sales and service network.
Makes sense. Those are necessary expenses to fuel growth.
Right. But they're not just letting those costs spiral out of control. They're taking steps to improve efficiency, like consolidating some functions between NIO and ONVO, leveraging the existing NIO network for the Firefly brand launch, and generally streamlining their non-frontline sales operations.
So basically getting more bang for their buck.
Yeah, exactly. And they're hoping to see these efficiency measures start paying off as sales volume picks up in the coming quarters.
All right, before we get to our speculative trade idea, are there any other revenue streams we haven't touched on yet?
Yeah, so beyond vehicle sales, they also have their other sales segment, which includes things like after-sales services and some technology licensing deals.
Okay, and how's that part of the business doing?
Interestingly, it actually turned profitable in Q4 2024 with a gross margin of 1.1%.
Oh, wow. So they're making money beyond just selling cars.
They are, which is a good sign. A lot of that improvement came from increased efficiency in their after-sales services and revenue from technology services that they're providing to some partners and affiliates. That brought in about 220 million RMB in Q4.
Not bad at all.
No, not bad. But they did mention that the technology services revenue is project-based, so it's not something they can count on consistently.
Fair enough. What about the after-sales services? Is that a reliable revenue source?
They believe so. As their vehicle fleet grows, they expect to see even more efficiency gains in their after-sales operations, which should boost profitability further.
Makes sense, economies of scale again.
Exactly. But their power services segment, which includes things like their battery swapping network, is still operating at a loss.
Yeah, that's not surprising. They're still heavily investing in building out that infrastructure.
Right. But they're confident that it'll eventually become a profitable part of the business as battery swapping becomes more widely adopted.
All right, last but not least, let's talk about their capital expenditure plans. They're clearly investing a lot in growth, but how are they managing their cash flow and funding all these initiatives?
Well, we already mentioned their healthy cash position of 41.9 billion RMB at the end of 2024. But they did have an operating cash outflow in Q1 2025, mainly due to the lower sales volume typical of that period.
Right, the seasonal dip.
Exactly. But they expect their cash flow to improve significantly starting in Q2 as new products hit the market and their cost-cutting measures take hold.
Okay, so they're not panicking about this short-term cash flow dip.
No, they seem pretty confident about their ability to manage their cash wisely. And regarding fundraising, they said they'll be prudent and will only tap the capital markets, both in the U.S. and China, when it makes strategic sense.
Smart move. Don't raise money just for the sake of it.
Exactly. Now, as for their capital expenditure, or CapEx, they did warn that it's going to be higher in 2025 than it was in 2024.
Uh-oh. That could make some investors nervous.
Yeah, it's something to keep an eye on for sure. A lot of that increase in CapEx is going towards tooling and equipment for their new product launches, which is understandable, but they're also potentially looking at starting operations at a third factory, which would be a major investment.
Wow, so they're really going all in on expansion.
They are, but they emphasize that they'll be very careful about managing the pace of those investments and will make sure they don't overextend themselves.
Good, good. Because running out of cash is a quick way to kill a growth story.
Absolutely.
Yeah.
And one clever way they're keeping their CapEx in check is by leveraging partnerships for their power swap network expansion.
Oh, interesting. Tell me more about that.
So they've got this program called the Power Up Partner Plan, where they basically team up with other companies to jointly build power swap stations.
So sharing the burden of those investments?
Exactly. And this is especially important for their Power Up County plan, which is focused on bringing battery swapping to those lower tier cities we talked about earlier.
Smart move. Spreading the risk and the cost.
Definitely. It shows that they're being strategic about their capital allocation and not just throwing money at every opportunity that comes along.
Okay, so before we move on to our outrageous trade idea segment, let's zoom out and talk about the long game. What's their big vision for the future?
Well, they're shooting for the stars, that's for sure. Their long-term goal is to become one of the top global players in the smart EV space, aiming for annual sales of 2 million vehicles, a 20% gross margin, and a net margin of 7% to 8%.
Wow, so they're not thinking small.
Nope, they're aiming for the big leagues. But they're also realistic. They know that reaching those lofty goals will take time and a lot of hard work. Their immediate focus is on getting to profitability, hitting that break-even point by the end of 2025.
All right, so eyes on the prize, but feet firmly planted on the ground.
Exactly. It's a good balance to have, especially in a fast-moving industry like EVs.
Couldn't agree more. All right, now for the fun part. The segment where we let our imaginations run wild and come up with a completely speculative, probably crazy, but potentially brilliant trade idea based on everything we've just discussed.
Let's do it.
So remember how they're betting big on battery swapping, especially for the ONVO brand. And remember how they believe it's a major competitive advantage, particularly as they expand into lower tier cities where EV adoption is still relatively low.
Yeah, I'm with you.
Okay, so here's the wild idea. What if we go long NIO, betting on their battery swapping strategy to really take off, but at the same time, we short a company that's heavily invested in traditional fast charging infrastructure in China?
Whoa, that's a bold one. So you're basically betting that battery swapping will disrupt the traditional charging model.
Exactly. It's a contrarian bet for sure, but hear me out. If NIO is right, and battery swapping really does provide a superior user experience, especially in those new markets where people are just starting to embrace EVs, then it could totally upend the industry's assumptions about how EVs will be refueled in the future.
Okay, I see where you're going with this. So as NIO's battery swapping network grows and gains traction, especially in those lower tier cities, it could potentially undercut the growth prospects of companies that are betting big on building out massive charging station networks.
Exactly. It's a high-risk, high-reward play, but it's based on a plausible scenario. Imagine if, in a few years, we look back and see that battery swapping has become the dominant way to refuel EVs in China.
And all those companies that poured billions into building charging stations are left scrambling to catch up.
Precisely. It's a wild card, but it's not entirely out of the realm of possibility.
I like it. It's definitely a thought-provoking idea. But of course, this is just pure speculation, folks. Don't go making any investment decisions based on our crazy theories.
Absolutely. This is not financial advice. And any trade idea, especially one as out there as this, should be thoroughly researched and carefully considered before you put any real money on the line.
Couldn't agree more. But it's always fun to explore these what-if scenarios, right?
It is. It keeps us on our toes and makes us think outside the box. All right, so to sum it all up, our deep dive into NIO's earnings call revealed a company that's firing on all cylinders with record deliveries, improving margins, a bold multi-brand strategy, and a big bet on battery swapping as the future of EV refueling.
They're also investing heavily in AI and are laser-focused on achieving profitability by the end of 2025.
They've got a lot on their plate, that's for sure, but they also seem to have a clear vision and a solid plan for how to get there.
Yep, they're definitely a company to watch in the EV space.
So for you, the listener, What were the key takeaways from this deep dive? What intrigued you the most? Was it their multi-brand approach, their battery swapping gamble, their ambitious product roadmap, or perhaps their innovative use of AI? We'd love to hear your thoughts.
Drop us a comment or send us an email. Let's keep the conversation going.
Absolutely. And in the meantime, keep those brains buzzing and those critical thinking skills sharp.
Because the world of investing is full of surprises.
That it is. Thanks for tuning in to TalkTickers, and we'll catch you on the next deep dive. Until then, happy investing, everyone.
See you next time.